Every financial disaster has been exactly the same. Let me show you. There has been a series of financial crises in the 21st century, and they all share gleaming patterns. That is to say that there are these cause-effect relationships between the various economic dynamics, from inflation, employment, interest rates, the price of stocks and currency, etc. All these have very predictable cause-effect links connecting them. And if you understand these links, then you can understand every other crisis that will come in the future, or crises that have happened in the past. And central to this story is one nation whose dynamics have affected every other nation from the last century. And we are going to look in particular at two principles. And if you understand these two principles, then you understand the basic economics from the micro scale, from normal transaction in your shop, in the grocery shop, to the trillions of dollars flowing around the economy every day. So let's get started. So the century or the millennium started with a loud bang. Employment was doing well, and everything seemed to be fine. And best of all, the stock market was booming, and new companies were coming up everywhere. You can see that the interest rates were somehow elevated just a bit, while unemployment was very, very, very low. And that can be attributed to the fact that there were companies booming everywhere and they were in need of clients. Money was growing healthily, and the stock prices were elevated until something terrible happened. There was a lot of borrowing happening, so that people could build lots of companies. And it was borrowing predicated on the fact that the companies that were being established were going to be able to sell, be able to make a profit, and then were going to they were going to pay back the loans that they had borrowed. And when it became clear that the model of borrowing, starting internet companies, and then depending on revenue to pay back the loan wasn't going to work, it soon became clear that the model wasn't going to be sustainable. So what happened? People started selling off. They started selling off their shares in internet companies, and suddenly there was a stock market crash. We can see that the stock sort of crashed from here up to here. So it was a very, very large time. And because the companies were going broke, employment also decreased and the rate of unemployment increased. You can see the green line. That is unemployment becoming more and more and more. You can see that the money supply was growing normally. This seems to be like a healthy growth in money supply. But there was a bit of a decrease in the price of oil, and that can be attributed to two things. Remember the two principles we talked about. The first principle is called supply and demand. That is, if there is low demand for something, its price will decrease, everything else being equal. If there is high demand for a product, that product will increase in price. And the same goes for supply. If we have a product and the supply increases, the price goes down. And if the supply decreases, all else being equal, the price goes up. So if, let's say, there is no economic activity, that is, the demand for oil decreases, and then the oil price will also decrease with that. So that is what happened during the dot-com. And here, after there was a lot of unemployment and decreased economic activity, the central bank swooped in and decreased interest rates. You can see their interest rates are the line in red. So interest rates, that was to encourage borrowing and economic activity. So that's the story of 2000 and 2000, the beginning of the century. Okay, after a while, there was a lot of build up of confidence again, and the crisis that would come next would be caused by housing. So companies and banks and people were buying into houses, and on top of that, new financial products had been built on top of the housing markets. There are things called mortgage-backed securities and collateralized debt obligations. So they are complex financial instruments that allowed the housing bubble to just get out of control. And what happened during then is that there was there was a decrease in housing prices. So banks that thought that they had lots of assets in houses sort of realized that they no longer had any assets. And what ended up happening is that banks were now like very cautious about lending out to other banks, lending out to people. And what happened is that there was uh, a squeeze in credit. So not many people the the banks are not willing to lend out. So businesses are not being established, and there was a credit freeze, meaning that there wasn't new money being loaned out to the public and also to companies and other banks. So what happened during then is that people now had to get to gold, get to stocks, and sell them in order to get back their money. And what ended up happening is the liquidation of assets, of financial assets like stocks and gold. And it was a whole year of banks breaking down and going broke. And there was a lot of financial uncertainty then, and a lot of freezing of economic activity. You can see that even the price of crude oil that reduced, driven by lower demand. But the decrease in the stocks, that was decreased by also lowering demand created by people selling off, which was also an increase in supply. So it was like all forces acting together to make the stock prices go down, as well as also gold saw some bit of decrease or stagnation. And then after the central bank of the US, which is called the Fed, so that there was going to be a lot of trouble if things were left to their own. So what they did was they lowered rates to 0%, which was like very crazy. Only Japan had been known to like decrease rates to such a level. It's decreasing rates to 0% to encourage borrowing, so that people would be employed and companies would start borrowing again. They also did some money printing. So you can see here money supply increased sizably around here, January 2009. You can see that a lot of printing happened, and that was to encourage economic activity, because once there is like economic activity contracts, that can lead to unemployment and instability and lots of things. At the same time, people were very unsure about what was happening, and they tried buying US treasuries. The reason for that is that US treasuries are known to be default proof. That is, the US government hasn't ever defaulted on its debts. So people generally tend to buy to buy US bonds. And in order to buy US bonds, you have to get dollars. So with lots of people clamoring to buy dollars, that is increased demand. And what did we say about increased demand? Increased demand makes prices go up. So the price of the dollar with respect to other currencies shot up. You can see here the dollar went up and became stronger. So that was one of the worst financial crises that ever happened in the world. It was a very contagious one. So if you're liking the video and you'd like more of this, hit that like button and let's go on. After the global financial crisis, the next crisis to come along, there was a bit of Greece and Europe debt crisis, but those aren't too major in my books. There was also an oil crash. You can see here around 2015, 2016, the price of oil or somehow halved, but it did not affect stocks so much. We can see that the stocks were like okay. The price of gold seems to have been going like downwards, and the money supply was just going upwards. And also the Fed increased rates. So the oil crash wasn't such a major event. I wanted to highlight it because sometimes you can have a major event in like a commodity or a stock which doesn't get spread out to the whole global financial system. So that is an example of such an event. So I think the deepest one or the most dramatic one was the COVID crash, and that can be attributed to that the pandemic had been something new. It's not something that had happened for nearly 100 years, so it was like something new, and people, like everyone, panicked basically, and people did not want to get sick. So what happened? People went home, stayed at home, and there was a decrease in economic activity. And what did we say? A decrease in economic activity leads to a decrease in demand for energy and oil. So decreased demand, decreased prices. So that is what explains this like deep in the price of oil. Also, stocks crashed because people were very uncertain, and in times of uncertainty, what happens is that the dollar appreciates, as you can see here, and on top of appreciating, people want to buy US Treasury bonds. So they basically want to buy US government bonds, and so they get money from their stocks. For gold, not so much. There wasn't so much extraction from gold, but that can be explained because there was a lot of uncertainty and people might not have been as confident in US bonds, so they also bought up gold. So we can see that stocks were affected negatively, gold went up positively, the crude oil went down because of decreased demand due to decreased economic activity, while the stocks were being sold off so that people could get their money and maybe put them in gold or US Treasury bonds. And the central bank, the Fed of the US, lowered interest rates like almost immediately, just from up to down immediately. The purpose of, and they also like printed a lot of money and they gave this money to people. So this happened a lot in the United States and in Europe. So people are being given like real money, actual money. This did not happen in African countries. I don't think any African country did that, but in US and in Europe and probably in other countries, there was a lot of printing and a lot of direct money to people's pockets. So that increased the money supply, and also the unemployment. Basically, that went up a lot, and the explanation is obvious. They want people going to work in the factories, so a lot of people were out of jobs. And you can see here that the money supply went up by a lot. It was a crazy amount. I think it was the most money that has ever been printed ever in the history of the world, I think. So there was a lot of printing of money, and this printing would ultimately come to hurt afterwards, because with there being a lot of money in the economy, the price of assets will go up, stock prices will rally because people are being given money, and because there aren't a lot of products in the economy due to the COVID, people were buying stocks a lot, and that's why at that time you could hear that stocks were hitting all-time highs. So what happened is that the Fed, in order to respond to that inflation in prices, because even consumer goods were like increasing in price, it raised interest rates. Interest rates is a common response to inflation, and actually rising interest rates usually is majorly because of there being inflation and employment being low. For example, you can see that unemployment was about less than 5%. So it was low enough to it was low enough to allow the rising of interest rates. And after rates were rising, the money supply decreased, and the dollar index, the USD, did not like increase substantially. It sort of was stagnated. Well, the price of crude oil would decrease, but wouldn't decrease substantially until the Iran war, which caused the price of crude oil to go up. And why is that? It's because the supply of oil had decreased. So those are the major economic events of the 21st century, and you can see the important role that the central bank of the US plays. It is the biggest central bank in the world, and its actions can affect the economies of countries and the economy of the whole world. So I hope you have a clear picture of like the major economic events of the 21st century. If you have any other events, you can put them down in the comments, and we can debate and increase our knowledge of macroeconomics. So if you would like to know how to better invest in stocks so that you can stop gambling with your money in the stocks markets, you can check out this video here. So have a nice one.